It is not the strongest of the species that survives, not the most intelligent that survives. It is the one that is the most adaptable to change. Charles Darwin. So we're talking about relative strength here, where you see rotation in the market and you see new names, new species, new stocks, and you have to make adjustments for that. You know, in this book, The Psychology of Money by Morgan Housel, he talks about a study done by J.P. Morgan. I've mentioned this before in the past, where it shows that the returns are very limited to the number of opportunities. So we're going to talk a little bit about opportunities. So when it comes to relative strength, if your portfolio is full of stocks that are underperforming, or you have stocks in your portfolio that are frogs, because you got to kiss a lot of frogs to meet your prince. So you want to look for the prince, and you got to throw the garbage out. But this is a very good book. I recommend it highly. It's basically saying very clearly that most public companies are duds. So you have to be very, very selective. So when it comes to relative strength, one of the best books written on this subject is How to Make Money in Stocks by William O'Neill. It says the 500 best performing listed equities for each year from 1953 through 1993 averaged a relative strength rating of 87. So it's on a scale of 1 to 100. 87 would be in the top quartile, just before their major increase in price actually began. So the determined winner rule is avoid laggard stocks and avoid sympathy movements. Look for the genuine leaders. Another good book for you. Now, Warren Buffett, who I respect tremendously, his favorite indicator is where he compares the market cap of all corporate equities to the gross national product. And so this particular indicator currently is at a reading, it says here we are at a 237 to 238%. Anything over 200%, in other words, the threshold Buffett used, Buffett noted that a ratio approaching 200% means investors are playing with fire. So in other words, the ratio is designed to say when you've got a GDP of X and you've got, the capital, the capital formation of all the stocks, when that ratio gets out of whack, it's telling you to be cautious. So you can see here where we are right now, and here's where we were back in the crash or the dot-com bust, and this is where we got up to in the 08 crisis. But you can see here that we are really in high territory. Now the problem with this indicator in my mind, it's just something to be aware of, is that yes, it is saying that stocks are grossly overvalued, and we're going to talk a little bit about why that is. But the problem here is that it can get more overvalued. So this is not like a sell signal. It's just simply saying you need to be aware of the fact that the market is pretty hot. Here's another ratio. This was the Cape-Shiller ratio, which is again showing readings above 40, which is the area that we get in trouble. So this is the dot-com bust. And this is where it's saying now that we're at 41.96 as of June. So again, we're back over 40 there. So things are looking kind of frothy here. Just be aware of it. Now, why is this happening? It's happening, I believe, now this is my opinion, but it's all based on a study done by Mike Green. And he's talking about passive investing. And he's talking about what they call passive vehicles, which is basically funds where money goes into these funds in a mindless way. It's passive. So in other words, no one's really using fundamental analysis to determine that this money goes into these stocks. The money's just going into the stocks because they're in an index. Now, back with the Pension Protection Act of 2006, this act was designed to remove pension liability from corporations. You know, the corporations have a pretty strong lobby, especially the mutual fund lobby is pretty darn big in Washington. And basically what this act says is that if you perform in your pension plan a certain way, it removes your liability. So one part of it is where if you have a default setting on your 401k that says that your employees go into an S&P 500 index fund or passive. But understand, there's no such thing as passive because there's money going in, money going out. So it's not passive, but it is a passive vehicle, is the way Green explains it. So in other words, it's mindless. It's where no one's making any kind of fundamental decision. Money's just going into, let's say, Apple just because they're in an index. So what happens here is that the 401ks have become massive, and this is since 2006. The pension plans, the defined contribution plans out there are up to about $14 trillion. Now that would be one of the largest, if not the largest, asset group in the world. So basically what he is saying is, it says, rather than being a low-cost, risk-free blessing for retail investors, Green argues that the exponential growth of passive vehicles has turned the stock market into an unstable, trend-following machine. So in other words, if you have a corporation, and I'll use Apple as an example. Apple is the largest company, in the S&P 500 other than Nvidia. And so Apple's really not growing right now. They haven't come out with any new products since the iPhone. The earnings have been relatively flat, but money is going into Apple stock simply because it's in an index. So this could be a real potential problem, and he is saying passive investing is broken. So these extreme valuations that we're seeing are being driven by what I would say artificial pricing and mindless investing. Now, when we start thinking about all that's going on right now, there's been a lot of talk about the AI bubble and so forth. Let's just kind of look at how this works, how the dot-com bubble worked. Now, in 2003, now this wasn't dot-com, but this is just an example that I'm using. In 2003, we started looking at Apple mainly because they had Macintosh computers and they had something called the, it was the device that replaced the iPod. They didn't have the iPhone. And so we were just seeing that the market was discounting something. So we started buying the stock in 2003, and you can see what basically happened here. It went from roughly 20 cents, 2 cents a share, split adjusted now. You have to understand split adjusted. And it got up to $6, which was phenomenal. But you can see here, once the financial crisis hit and basically the bubble popped, the stock came down dramatically. So another example, here's Amazon, but this is the dot-coms. So we started looking at Amazon in 1997. And I can remember getting the phone call with one of the analysts that I was working with at the time, and he said, well, we want you to take a position in this company, Amazon, which is a beneficiary of Cisco, and we'll talk about Cisco. Because Cisco invented the internet, basically. They invented routers, internet routers. So this particular analyst said, we hear they might start selling tennis shoes. Well, we know it's much more than that. So anyway, the stock, if you do a split adjusted price, we're looking at about 1 cent per share. And it got up to $5.40. But when the bubble popped, everything just came roaring back down to about 5 cents. So, you don't want to underestimate what can happen with a bubble because it can be quite devastating. So here's Cisco. Now, we discovered Cisco in 95. And basically, it was the hint that this was going to be a big deal. But what was interesting was that Amazon was a beneficiary of the dot-coms. So, I mean, if you look at the numbers on Amazon, you look at roughly 1 cent to 5.5 cents. Whereas if you look at Cisco, it went from basically $1 to $52. So Amazon was really the one he wanted to be in. But this was your lead in. This was your hint. I did not understand the internet when it first came out. But once I started to understand Cisco, then that led me to some of these other names. So we got down the road a ways, and around 2012, in fact, I bought my Tesla. I bought a Tesla Model S in 2012, and we started buying the stock. Well, you have to see here how long it went. It went from 2012 to 2020 before it really lifted off. So you had to have a lot of patience in here. But you can also see once that 2022 bear market hit, it gave back. It went from roughly $400 down to, $110. So once the bloom comes off, you need to take defensive action. So right now we've been dealing with NVIDIA, which is announcing earnings today, in fact, after the close. You can see that NVIDIA really started to take off in 23. Now, we owned the stock back when they were just in gaming technology, mainly semiconductors for gaming operations. But you can see here this thing really took off, and we pretty much missed it. We just did not understand what was going on with AI. But even more than that, we were looking at the fact that the company's market cap was extremely high. So right now the market cap is $5 trillion. So, back to what Buffett was saying, you need to pay attention to market capitalization. So when we look at a company and we think the market cap is too high, it tells us to back off because of valuation. So here's Palantir. Now you can see here, this is a software company that we think is going to benefit just like Amazon benefited from the invention of the internet. We think Palantir is going to be a beneficiary of AI. So you can see here, the stock, just like NVIDIA, started to take off in 23. Now it is somewhat rolled over, but it is starting to consolidate a little bit. So we're going to go ahead and we have taken a position in the stock. But again, it's just whether or not, is this a bubble that has popped and it's rolling over? We'll just have to see. Now, just kind of take a quick look at the market here real quick. Here's the NASDAQ. We got the high, we got the lower high. Then we basically have a lower low and then now a lower low. And now we're just consolidating. So there's no rush on anything right now because the NASDAQ is really somewhat underperforming the overall market right now. Because if you look at the S&P, you can see it's holding up a little bit better. You got your high, but then you got higher highs. So what my opinion is right now is that you should be kind of looking at S&P type stocks right now versus hot NASDAQ stocks. So if we look at the aggression index, this kind of says the same thing. We've got the NASDAQ divided by consumer staples. We've got the high, lower high, the low. We kind of rallied. We try to consolidate. Now we're breaking down, but it's holding still. So in conclusion, what I'm saying here is there is rotation going on here. It's the survival of the fittest. And we would say use relative strength as a tool, as a way to help you find the next winners. If you have any questions, please let me know. Thank you very much.